Baird putting out a note recently that the party is over for American financials, saying, quote, net interest margin trajectory gets tougher from here. Bank valuations are tempting, but given higher odds that net interest margins grind flat to lower into the end of the cycle, investors should remain disciplined with bank exposure. The voice behind that note, David George, joins us now, a senior research analyst at Baird, and he joins us on the phone. David, great to have you with us on the program. Just walk me through the thinking. Did the party ever really get started?
Yeah, in terms of bank margins, and good morning, by the way, we've had a good kind of 8 to 10 quarter run in bank margins, in addition to loan growth has been pretty good. So it's been a good environment for margins for really a couple years. And all we're really saying here is, Jonathan, is that margins are likely to peak here in the first quarter, and it's going to be much more difficult for the group to grow net interest income over the next several quarters.
So, David, just walk me through something important. I've been thinking about this for a while. We've seen the Treasury curve and the spread and the shape of the curve flatten over the last year or so. And when it flattens, the financials come under pressure. But when the banks report, I don't see that pressure in net interest margins. Just how tight is the correlation between the shape of the yield curve and net interest margins for these banks?
There is definite correlation, but it occurs with a lag. So there are two issues that are going to influence margins from here, in our opinion. The first is obviously the shape of the curve, and really the banks are most sensitive to the 3-month to 5-year spread, which is essentially zero at the moment. And that pressure, we think, is going to be exacerbated by a couple things. First, loan price competition, and in our report, we discussed the fact that loan spreads have gone down 30 to 40 basis points over the last year, and that's reflecting competition, probably some manifestation of tax cut benefits, et cetera. So you're still, not only is the curve problematic, but loan pricing is also becoming more challenging.
David, there was some hope that they could make up for this with volume as net interest margins come in. Do you think that hope's misplaced now?
It's going to be tougher. Loan growth has actually been a good part of the bank story for the last couple of years, and I think we're trying to think through, Jonathan, not only the shape of the yield curve, but the absolute level of rates and what the Fed is really saying about the macro environment. And should we expect perhaps a more subdued amount of loan growth over the next couple of years? And we think loan growth is going to be a little slower than it's been in years past, just given the leverage that's out there in the corporate sector in particular.